Alright, what's up everyone? We'll get started here in a minute. You know, the crazy thing is, we've been having some pretty good weather in New York. It's actually been quite warm the past 2 days, but tonight it is cold. And I believe it's only going to get colder as the night progresses. We may even have a little bit of snow as we head into Friday and Saturday. Anyway, we'll get started in just a moment. I wanted to pop on and say hello to everybody, check in, see how the week is going. Hopefully everybody's doing well. I'm happy to see everybody. We're also going to be doing some testing today. I did finally upgraded my phone. I think it's been, I think I had an iPhone 14, I think. In any event, we are broadcasting live from an iPhone 17 Pro. I've spoke to many of you about, you know, how you like the phone. I think Alan from the chat has had raving reviews about the iPhone 17. And it's a really, really nice device. I've only been using it for about, I don't know, maybe 8 hours, but it's a really, really nice device. Very clean, and the camera is quite good. So who knows, maybe as the week progresses, I'll have to film some, you know, 4K, maybe 120 frames a second on the iPhone 17 Pro. We'll see. Let's see who we got in the chat. I see Michelle Henry. What's going on? Moonlight is here. Says, hey Tom, tuned in just as I heard you were moving on up in the phone world. Yeah. I mean, I usually, I really ran that one into the ground. It had so many cracks on it, so I just thought it was the appropriate time. Hal T16 is here. Monday, what's going on? I see Sabrina Fair. Welcome to Central Park South. We are now overlooking the beautiful New York Athletic Club, as you can see here. And we are facing the Upper East Side. So you can see a little bit of the Pierre Hotel, the Sherry Netherland Hotel, and even 520 Park. I see Tesla. James is here. What's up, Tesla James? We'll talk a little bit about Tesla tonight. PD says, what's up, Tom, from Brooklyn? Hopefully you're doing well. I see Sally Walters here. And the one and only Lee from Miami. Now here's the funny thing, Lee. It was perfect weather when I was down in South Florida, but apparently you guys are getting a pretty significant cold front. I think it's only like 50 degrees in Miami right now, so it should feel pretty cold. I mean, with the wind chill tonight here in New York, it feels like 16 degrees. Like, it's absolutely freezing. So definitely a massive difference from walking around in 82 degree weather to now being, you know, freezing. Monday says, Tom, curious your thoughts on Serhant in general with their Netflix TV show. As a real estate guy yourself, I haven't seen the show, but I do know Ryan quite well. My boss is very, very close friends with him. My boss was, how would you call it, a co-host or a co-star on $1 Million Listing New York. He just runs a very different business. He runs a very smart business. He's a media company first, and then a real estate brokerage second, which is actually very good. And I've said this before, like the brokerage business, in terms of like real estate brokerage, residential, it's not a good business. And maybe I shouldn't be saying that, but I don't really do much residential sales. But if you look at the business as a whole, it's in structural decline, and that's not necessarily bad. I think it's just an old industry that really hasn't been disrupted, but now it's starting to get disrupted. So you have a few things to play. You have significant commission compression, right? So I think what you'll see, if I had to make a prediction, and then we'll kind of move on here, in terms of like selling residential real estate, what I would like to call normal residential real estate, because Manhattan is, and New York City in general, is just so different from any other market, right? I mean, it's just because the price points are so high, particularly if you're dealing with, the luxury space, which I consider that to be, $5 million property and up. And very, very seldom will you do transactions at the lower level. And oftentimes when you see these monster deals that'll close, even a $10 million to $15 million apartment or home that sells, the commission that you make on it actually isn't all that high, and the margins are very, very slim. So you might see some of these publicly traded brokerages, right, have massive top line revenue. But if you look at the gross margins, it's nothing in the grand scheme of things if you're comparing it to other businesses. Like when I was in the software business and the telecom business, the margins were like cartoonishly, I always use the term like cartoonishly insane, right? I mean, I was selling products with 97%, sometimes 100% gross margins. So the commissions on those deals were insane, right? And that model, right, depending on what you're selling, like back in the day, I would sell a lot of cybersecurity software, right? So I would sell, like, I'll give you an example. When I was a director of enterprise sales at Hyperion Partners, I didn't have a salary because I got profit sharing in the business. Ooh, that bus almost knocked off that bike. I don't know if you guys saw that. But I had profit sharing in the business, so I would essentially get 25% of the net income of the business of the Northeast, right? So if we would, make, just to keep it even, $1 million, my profit would be 25% of $1 million, with some of that profitability being recurring revenue, right? So it's called like your tails is what we used to call it in the industry, because if I had a client that I sold 100 licenses of a CrowdStrike software, Zscaler software, I would get paid on that every single year they would renew. In the real estate business, particularly selling homes, you sell something once and you have to go out and hunt for the next deal. There's no reoccurring revenue. And the amount of effort that goes into the business of actually selling the property is very laborious, and it's just not a good business. So the reason why I really appreciate Sirhan, right? And I don't have the financials on his company, but I bet you anything, right? And this is just all speculation. I don't know any of the financials of his company. I would say in terms of his net income, he makes the lion's share of the money on Sirhan from the broadcasting, from the media, and from the sales of I think he has some training company. I don't think the majority of the profitability comes from actually selling the real estate, which is the funny thing. But it makes sense because it's such a slim, low margin business, particularly in new development, by the way. I don't want to go off on a big tangent, but let's say if you're pitching a massive project, right, like 220 Central Park South, when a brokerage launched sales on 1 Wall Street or 15 Central Park West, there's so many firms competing for that business, and the developers know that. So between the reporting, all of the software that you have to print out the reporting for the developers, to the marketing, right, that all goes on. Depending on the structure of the deal, that all goes on the brokerage, right? So if you sell, let's say, a $40 million penthouse at XYZ new development, you know, by the time you actually get paid the commission, you know, the marketing costs come out of it, the, you know, the kickback to the developer comes out of it. Maybe some concessions come out of it if you know, they're paying the transfer tax, the mansion tax. So really, when all's said and done, it's still a lot of money, but the margins are so slim. And the last thing I'll say, in Manhattan specifically, it's like the Pareto principle on steroids, right? And I'm sure everybody's heard, you know, 80% of the outcomes are driven by 20% of the people. In Manhattan real estate, at the very, very highest end, it's probably like 2% of the people drive, you know, 98% of the business. Quite literally, right? Like if you're looking at the monster transactions, you know, the trophy properties, it's, you know, a very few select teams at Corcoran, a very, very few select teams at Sotheby's, like Nikki Field's team, for example, that's on Steinway Tower. You know, I think a few other big ones like Steve Gold, who works in our office. And those teams drive the overwhelming lion's share of the big business, like all the big deals. So that's kind of what I think. So to kind of wrap it up and get back to your question, I think he's built something which is what you need to build if you're going to be in this business. You need to have, you know, high margin things, right? Because the media business is very high margin, right? You know, extremely high margin, particularly the content style that a lot of newer people do, right? I'm not talking about content style like a Fox News or a News Corp where they're, you know, they have billions of employees and they pay the host like $25 million a year. If you can run a very lean and mean operation, media company, and a research company where you could put out solid research, I mean, you can be probably printing 70% margins, maybe even more. Hey, NBA Elias, good to see you. Hopefully you're doing well. Larry Adams, cheers to you. But yeah, guys, we're gonna be going back to Grand Central Terminal tonight. I just wanted to pop on and talk about a few things that are going on in the market. Right now we're looking back at the gorgeous Plaza Hotel. I see Mike is here. What's up, Mike? TD, Teresa Diaz, good to see you. And then you can see the very interesting spire of the Steinway Tower. But I would say if you are looking to build a really solid network, this is a very good business to be in, because you know, if you should really already have an existing network, right? Kind of before I got into this business, I had a career for over a decade, right? Working in big tech. I worked at Fortune 500 companies my entire career, so I've had a monster network already, and I already had money, right? To be very blunt, because you know, in this business, you don't have a salary, you don't have healthcare, you don't have anything, but you have to live in New York City, which is the most expensive city in the world. So it's the barrier to entry in New York City is very high technically, because I mean, how are you going to survive? So I use it in a way where I'm very blessed to get a lot of exposure to some very, very interesting and very successful people that I can then contract out and do other work on bigger projects, right? Whether that's, you know, modeling a land deal that a developer is going to potentially develop property on, or selling off massive bulk assets of, let's say, a huge parking garage portfolio that never hits the market, right? And I have to shop that to, you know, maybe some large private equity shops, maybe some smaller private equity shops, right? And for those niche deals, I can build in a lot of margin because it's essentially like they're hiring me to be an analyst for them. And what's the going rate for an analyst at a PE shop or something like that, right? Probably like, 250 to 300 grand. So these people are happy, to pay 6% to sell off a monster portfolio of assets that aren't residential, something like that. But I really wanted to talk about, the general equity market overall, and something that's very encouraging that I'm seeing as we're coming up on Madison Avenue here. I just quickly want to show you guys this view. This is a sick cityscape view of 432 Park Avenue and the Four Seasons Hotel. Now, I was reading a lot of articles, for projections for 2026, and there's still a lot of negativity out there. I would say the number one encouraging thing for 2026 that I see so far is that the major financials are doing so well. Does anybody notice that? If you look at, a screener of, stocks hitting new 52-week highs and new all-time record highs, consistently what pops up for me, Goldman Sachs, that's going to hit $1,000 a share probably within the next month. Morgan Stanley, new all-time record highs today. So these are some of the largest investment banks in the US, and they are trading really, really well to new all-time record highs. Now, what does that mean? Well, to me, something that we've been writing about, honestly, since the lows in 2023, is the prediction of the resurgence in the IPO market and the M&A market, right? And we've really seen deal flow pick up significantly in 2025, not only on the IPO side, but on the M&A side. There's been a lot of merger activity, a lot of deal making, and anecdotally, all of my friends who work in investment banking and different technology groups, healthcare groups, told me that they were really, really busy last year. And if you have these stocks like Goldman Sachs, like Morgan Stanley, even JP Morgan in gear in terms of their stock, hitting new all-time record highs, to me, that's the market telling us that there should be a continuation in deal flow for 2026. And I would totally agree with that. Now, taking that a step further, if there's an increase in deal flow, M&A, takeover business, spin-offs, you name it, equity advisory, equity underwriting, IPOs, that's going to mean increased fees for these banks, because these banks make their money off of fee income, right? They charge fees to advise, company X to buy company Y. They charge a fee if they're going to take a company public. So the more deals that they do, generally speaking, is more fee income for the bank, which should lead to higher earnings, higher net income, and higher EPS. And that has massive trickle-down effects for not only the overall economy, but the stock market as a whole. So, at least for me, as we're standing on the corner of 58th Street, it's very encouraging to see financial stocks, particularly bank stocks, perform really, really well. Now, if it was the opposite, right? If I was looking at, a bunch of charts of these big investment banks, and I saw JP Morgan Chase crashing through the 200-day moving average, if I saw Goldman Sachs rolling over, cutting through the 50-day, Morgan Stanley, then I would probably say that that's the market telling us that something is wrong. There's probably going to be, some bottlenecks in the IPO market and things like that. And if you do a post-analysis of how these major bank stocks trade, they usually lag earnings by roughly 6 months. And that really showed up. I mean, if you could just model this yourself, and you could use Grok, you could use, ChatGPT, Gemini, and very easily do this. And you could chart the earnings chart, or the EPS. And you started to see Goldman Sachs roll over in 2021 into 2022 and kind of bottoming and leading. The stock was leading into 2024, and you had earnings follow, right? This is now 57th Street. Because guys, you gotta remember the top in 2021, right? There was this monster frenzy on Wall Street. There were IPOs coming to market, pretty much every day. If you remember, in 2021, there was a new SPAC, a special purpose acquisition company, coming to market seemingly every day, which, the vast majority of those were fraudulent in my view. It was just an absolute frenzy, and bank stocks were taking off, and the whole market was taking off. Then we had the very, very big hiking cycle by the Federal Reserve, which made money very expensive. The IPO market essentially went dormant for 18 months. Not a lot of deal flow, not a lot of transactions in the M&A space. And now we're just kind of breaking out of that just over the last 12 months here. You're starting to see some really successful IPOs. You're starting to see some blockbuster deals on Wall Street, and that should continue into 2026. So that's kind of the main takeaway that I have in terms of the big picture that's encouraging to kind of propel us through 2026. So should there be a correction in the overall market, let me rephrase that. When there is a correction in the overall market, that to me is a sign that that dip should probably be bought and that the market's going to go a lot higher, right? Because we're already about plus maybe 36% on the S&P since the lows of the tariff crash in April, right? So, if we get, maybe during the summer doldrums, minus 10, minus 15% on the S&P, I think you should look for some pretty big opportunities to get long stocks. I know that sounds crazy. I know a lot of people are like, no, this is going to be it. This is going to be the big one. But so long as earnings continue to come in strong, I remain optimistic on 2026. Anyway, we're now standing outside of 432 Park Avenue. This is quite the unique building, and we've finally opened up this public space after I think they were working on some renovations. Let me duck into the chat and see who we got. The one and only Patrick Connolly is here, the luck of the Irish. Good to see you, Gary Carpenter. What's up? Carl Roth says, Tom, isn't that the way these businesses have always operated? Types of businesses that are doing very well these days are the ones that are in business. I'm not sure what you mean. Carl Roth says, IPOs are great in all, but really what happens when two companies merge is usually one is not doing so well and the other is doing so-so. So they merge together, taking the risk. In some cases, right? Well, isn't that what's so great about capital markets, right? So oftentimes a company is not doing so well, but if it's run by better management, it can be doing exceptionally well. right? That's really what if you want to talk about activist investing, right? So a lot of, famous deals in activist investing is, you'll have a hedge fund, let's just give for example, that'll say, look, this company should be trading at such a higher valuation than it is right now, but management's, stupid, they're not running the company well, they're mismanaging the place, and they should spin off this business and sell this business to somebody else and just focus on the core business, and then the stock should take off, right? So they take a majority stake in the company. They can get board seats, they can make some significant changes in the company, and then the company does really well again. So that's all part of the normal process in capitalism, really. Hey, Jay is here. It's good to see you, Tom. Cheers to a fruitful 2026. Likewise for you. Hope you're doing well. Stephen Bate is here. The ABX girl. What's going on? And 10 Red Buff. Always appreciate you joining. And Guy Tweedy is here from England. Hopefully you're doing well. It's been a pretty busy day. I mean, what are you guys seeing out there? I think we're gonna have to turn back because Madison Avenue might be just too windy for us to walk down tonight. But what do you guys think? Do you think are some of the big themes for 2026? What should we be looking out for? What sectors do you think are gonna perform poorly in 2026? In terms of poor performance, I think you might see a major continuation, or if not like a capitulation, in software, in SaaS. I think software will continue to underperform. Lex says, Tom, speaking of mismanagement, what do you think about the bankruptcy of Saks Fifth Avenue? Well, I'm not super familiar with it, but if I had to take a guess, it's just very, very difficult to run a brick and mortar operation nowadays. In terms of profitability, it's very difficult. The Amazon effect. And, with Saks, from my understanding, and I'm not a big retail guy, I don't really cover the sector, but I mean, if it were me, I would never get into the brick and mortar business unless it was some sort of fast casual food business or like, a big grocery chain or something like that, because it's very difficult to make any money. The margins there are very slim. Even in grocery stores, margins are very, very slim. If you look at some of the biggest grocery stores, they're running on single digit margins. There's like no margin in that business. It's horrible. In other business, because, and this will kind of wrap around to our conversation maybe about 20 minutes ago when we were talking about real estate brokerage, how horrible that business is. And I know it kind of sounds like crazy that I'm not being negative on it, but there's no margin in it. It's such slim margins in the residential real estate brokerage business. Another one is the restaurant business. Like, opening a restaurant is, generally speaking, a terrible idea. There's just no margin in it. And there's just too many things that could go wrong. And it kind of sucks to say that, but, a lot of restaurants run on very, very slim margins. So I would say, in terms of Saks Fifth Avenue, more of the Amazon effect, direct to consumer. I think these big, luxury chains, maybe even like Bloomingdale's, Macy's is having a little bit of a tough time. It's tough. NBA Elias says, Tom, I think the idea of a credit card interest rate cap and the curbing of big banks owning homes proposed by President Trump will be a non-factor for bank lending and profits. Yeah, that's an interesting take. I'd be curious to see why you think that. I'm very, very curious on your take on that, and I'll kind of give you my take, but that's another interesting conversation we could have right now. This is 425 Park Avenue. Guys, the Ferrari, not dealership, but the Ferrari showroom is going to be moving directly into the retail unit of 425 Park. This is the temporary headquarters of Citadel and Citadel Securities until Ken Griffin builds 350 Park, which is going to rival 270 Park Avenue. But I mean, what an amazing location for the Ferrari showroom. I mean, if you have all these quants knocking down $2-3 million a year, you know, they could window shop at the Ferrari. So whoever is in charge of marketing at Ferrari should probably get some sort of a raise. Our friend Guy Tweedy from England says, Tom, times are changing. The retail shops can't compete with Amazons of the world. High rents and taxes. Hope for the best. Expect the worst. Yeah, no, I mean, I totally agree with you. I believe the retail, the brick and mortar businesses that will succeed will get very, very good at online ordering and pickup. Shane, thank you so much for your $2 donation. I appreciate it. You're talking about the Chrysler building because the Grand Hyatt is going to be torn down, and in its place is going to be a huge Class A office tower that's going to block the views of the Chrysler building from 42nd Street and 5th.
Oh, I do like that.
No, Kroger is a really well-run big grocery store chain. Hey, Kevin is here. Kevin Hawthorne, what's going on? So I guess we'll talk about what's it called? President Trump's statement that he wants to force credit card companies and banks to cap their interest rates at 10%. Did anybody hear that? Who here in the chat heard the news that President Trump came out and said that he wants to mandate a cap on credit card interest rates? Now, for the record, I think that's a horrible idea, and I believe that the president he himself doesn't even believe that that is a good idea. He's just, you know, talking out of his you-know-what, as he usually does, to placate because we have midterms coming up. Larry says, yes, you've heard it. Okay, so everybody's pretty much heard it. So I won't go into explaining exactly that. But NBA Elias, let's see what he said. He said the caps on credit card interest rates will most likely never get through Congress. I agree. That's one of the main reasons why I believe Trump is saying it. He knows it's never going to happen, but he's saying it is more like a populist movement to be like, you know, I really care about, you know, the working class. You know, I'm going to do what's right for the little guy. And by the way, that would be one of the worst things that could possibly happen to the little guy, right? And it might sound counterintuitive, okay? You might be saying, well, Tom, that doesn't really make any sense. You know, if my credit card interest rate is 25% or 30%, I would love for my credit card interest rate to be 10%. That would help me out so much. Well, here's why it wouldn't. Because the only reason, right, and I'm not talking to you specifically, everybody is in a different situation, but the reason why people have a very, very high interest rate on their credit cards, generally speaking, okay, if you have a very, very high interest rate on a credit card or some type of loan that you have with the bank or a credit card company, it's due to the fact that your credit worthiness is, not saying that in a demeaning way, but in order for the bank to extend that loan to you, they need to underwrite the deal. And the shittier the deal, excuse my language, the higher the interest rate has to be, because that's how the banks quote unquote cover their ass. So, you know, in order for the banks to extend credit and give somebody a chance, to give them that second chance, to extend them that credit, well, they're going to need a higher interest rate, right? It's just, think about it like the bond market, right? If it's junk rated debt, well, the interest rate on that debt is going to be pretty high, right? And that's why a lot of people like to buy junk rated bonds, because bigger risk, higher return, right? Sometimes, you know, junk rated debt, you know, you could be getting paid 20% on it.
And
If
honestly,
you
I
mandated
was distraught
that
about
banks cap the interest rate, they would just stop extending credit to, honestly, the people who might need it most. And you might have a big credit crunch. That's what a lot of people aren't thinking about. So if you had a situation where the banks, the credit card companies were forced to cap the interest rate at 10%, well, they would just probably close a lot of people's accounts. And that would be a really, really bad thing. Like, you cannot have government intervention in the free market. Now, to wrap it back to NBA Elias' point, it would probably never go through in the first place, right? That's why I believe this is kind of Trump just being Trump. I mean, we know the playbook, guys, right? I think we've been through Trump so many times, right? And obviously this is only his second term. The reason why I say so many times is because we've been dealing with him since 2016. And, you know, I live in New York. It's a very liberal city. I'm a more conservative guy. And so, you know, a lot of people talk to me in this city, clients, friends, and they just can't stand Trump, and they get so angry about him. And I'm like, guys, like, we know that he talks out of his you-know-what. Like, we know all of this stuff is nonsense. Just don't pay any attention to it. Like, that's if you've studied persuasion, okay, particularly Trump's persuasion, that's his persuasion style. His persuasion style is saying something so crazy that you'll be like, what? Oh my God, no. Like, if you do that, that would be such a disaster. And then he reels you back to the table, and then you settle on something less crazy, because he throws the craziest thing out there, right? Like, that is Trump's negotiating tactic. What can you say at the negotiating table at first that is like so bombastically crazy, where everybody freaks out, right? It's a 5-alarm fire, and then guess what? Nothing even ever materializes from it. So that's kind of the way I think about it, is that yes, it's a bad idea. It's a horrible idea, but I don't even really think about it because it's never going to happen. That's my take. Maybe I'm wrong, right? Maybe I'm wrong, but that's my take on it. We're now right here on the corner of 51st Street and Park. Larry Adams says, but Tom, the markets pay attention and you will lose your shirt dealing with him. Not really. I mean, you know, he's announced that a long time ago, and there's been nothing crazy, like super crazy going on in the bond market, like nothing really out of the ordinary. The only trade which has been a very successful trade that we've seen is a major push into hard assets and precious metals, right, or real money, because we know a few things. We know that this administration wants to spend a ton of money, okay? That's number one. And I wrote about this in the newsletter a long time ago. You know, I said, look, Trump is a real estate guy from New York. Let me ask everybody a question in the chat, right? Give me one real estate developer from New York City that is a conservative person fiscally, and that doesn't take a lot of risk, and that doesn't take on a lot of debt. Name one. Like, I deal with real estate developers all day. Not one of them is a light spender, and not one of them is a very conservative risk taker. They are huge debt people. Okay, they spend and they leverage heavy. So to think that Trump would come into office, right, and really do everything he can to reduce and slash government spending, you know, Trump is a growth guy, Trump is a debt guy, and that's exactly what the market has affirmed. And why do you think he's pressuring Powell so much to slash interest rates, right? Grow the size of the balance sheet, right? That's all stimulative activity. That's not contractionary activity. That's all stimulative. So you've been seeing this monster push into precious metals like gold and silver. That's been, you know, even platinum, palladium, that's been the big trade. And it's really caught a lot of people off guard. But again, if you just like follow the framework, we know the framework of how Trump acts. You don't have to like Trump. You don't have to hate Trump. You know, what I try to do is just take the politics out of it and think and just study Trump. We know what he does, right? We know the type of person he is. So if he tells you one thing, right? If you see an anomaly, right? If you notice an anomaly between what he's saying and what he usually does from history, well, then you just go on the other side of the trade, right? You just go to the other side of the trade. Hey, Trade Brigade. Speaking of trade, hope you're doing well. Trade Brigade, you're gonna like this one. We got 270 Park Avenue coming up right here. This is the brand new JP Morgan Chase office tower. It's such a fascinating looking building. This thing is insane. Trade Brigades, this dude, nice conviction off of GLXY, the 200-day moving average. Yeah. Oh yeah, that we didn't even talk about that. That was another major piece of news today. GLXY Digital, quite literally as of now, is one of the largest data centers in the world. So here's a little bit of prediction what I think is going to be what I like to call phase 2. So now that we have all of the approvals, you're probably, before earnings, I think their earnings is February 3rd, I think, is earnings? I don't know, don't quote me on that. You're probably going to see an announcement that they've signed a massive lease with one of the major hyperscalers. So obviously they've signed that lease with CoreWeave, and they've been able to command a little bit of a premium from CoreWeave because the creditworthiness is not bad, right? Or the creditworthiness is bad, sorry. So to kind of hedge your risk, they're not going to give CoreWeave the second half. They'll probably give that to a Meta. They'll probably give that to Microsoft, maybe Google, perhaps, or maybe Nvidia takes it. But they're going to sign a monster lease with a huge name, a massive hyperscaler. And you know, if they can start delivering power by second half of the year, I mean, it's going to be a big cash cow. So it's been one of my more riskier bets. Obviously, the name is very volatile. It's like a $20 stock, $30 stock, and it doesn't trade much. That's the other thing about GLXY. They are NASDAQ listed, but the thing has no volume. It doesn't trade. So that means you're going to get whipped around. So if you're going to be in this name, you kind of just have to be in it for the long haul. And as you get more approvals for more power to come online and to really build out this data center, my belief is that once they start cash flowing from the data center, you're going to start to see a huge pickup in volume. So the stock's going to start to trade because institutions, big institutions, will be able to buy it. They can't buy it, this thing right now. To some extent, they could buy it, but it's such a little flea of a name. It's like a $10 billion company. But once this thing gets going, I mean, I think you're going to start to see a re-rating in the stock. This is right outside of 270 Park. I think the internet might be a little bit iffy, but guys, look at this shot, 270 Park Avenue. What a building. Wow. Trade Brigade, good to see you. Yeah, Trade Brigade says $119 million worth of volume today. On the news, a lot of volume came in, way more than usual. Cap says the wind sounds brutal. It is brutal. It's freezing here, guys. It feels like 19 degrees out. It's definitely too cold to be walking around. Sabrina is all in on Bloom Energy, VW, HUD 8. GLXY. It's definitely a risky portfolio. But you know what? Bloom Energy is actually a really, really solid company. And I don't think, again, I don't believe that GLXY actually is as risky as many of the analysts are making it out to seem. There's two problems. And it's not a problem with me. I actually don't care. But it's with most people on the street that are like boomers in a sense, right? I don't know anywhere else to explain it, but the story of GLXY is very different. Like, I've been following this company. I've known a lot of people who work at the company. I've met Mike Novogratz. He's a really nice guy. Since 2018, when this thing first went public on the Toronto Stock Exchange. And it started out as they wanted to build like the Goldman Sachs, or the Goldman Sachs of crypto, right? That was Mike Novogratz's vision. So they acquired a lot of these sites in Texas to mine Bitcoin, right? And then to build out custodial services for institutions to custody their Bitcoin. They have a sales and trading operation. They have a huge sales and trading desk at GLXY Digital that they run really, really well, being that Mike Novogratz is one of the greatest macro traders of our time. And then you kind of had this AI wave take over, and they got lucky. Like, they got really, really lucky to have some of the most prized assets that could be converted into data centers. And they essentially just stumbled in to Helios, which is right now the largest, or going to be the largest data center in the world. And once you start collecting rent and really ringing that register from CoreWeave and probably Alphabet, we don't know who they're going to sign with next. I mean, it's going to be a cash flowing machine at extremely high margins. Now, the crypto business is difficult, okay? It's difficult to put a valuation on that because it's very volatile. You know, Bitcoin could be trading at 120 and then it could be trading at 90. So if you have a lot of Bitcoin on the balance sheet, a lot of crypto assets on the balance sheet, it's going to be hard for the market to assign that stock a premium, right? And the way we make money in the stock is if the stock goes through a pretty healthy multiple expansion. So I have a few predictions that I think that'll happen with that company. They'll probably spin off the data center business by the end of the year. That's one of my predictions. So it's easier to tell the story, like if you're an investor relations person, it's easier to tell the story to an investor if they're two separate businesses. If you keep the data center business with the crypto business, people get confused and they don't know how to assign a valuation to that business. But if you spin off Helios and you have a standalone data center REIT, I mean, my God, it's going to be insane. That's my prediction anyway. This is the Yale Club here. And finally, all of the scaffolding is off of the Yale Club. And this building looks insane with the top of One Vanderbilt there. But look at the spire of 270. During the holidays, they lit it up for Hanukkah, Christmas. But February, I think 10th, I'll be back in Miami. I'm going to be covering the Miami Boat Show. So hopefully I'll be there for maybe 2 weeks. But Trade Brigade, what are you watching? Anything specific? Any sectors that you think are going to outperform this year? I was saying at the beginning of the broadcast that I'm very optimistic the way banks are trading, particularly Goldman Sachs approaching $1,000 a share, new all-time record highs. Morgan Stanley, new all-time record highs. So that tells me that there's probably going to be a continuation in deal flow, M&A activity, IPO activity, and that's really the core that drives the market. So I said, look, if we get a correction over the summer or something like that, I think that correction should be bought. And perhaps software, a lot of the SaaS names continue to underperform as, you know, AI data center really takes over the story. And perhaps you're going to have a big bull market in energy this year, because you need energy to power all this stuff. We're now right outside of One Vanderbilt. TD Securities is in this building. KTUS, AVAV. I'm gonna have to check those out. Let me screenshot. Hey, Raj Rupani, what's up? Says, what do I think about? Oh yeah, didn't Tom Lee invest some money with Mr. Beast or something? So Raj, I saw that, but I don't really know too much about it. I haven't had time to read about it, but I definitely saw that. Yeah, I wonder what they're going to do with that. I have no idea. Interesting, right? Yeah, Tom Lee is, he is awesome. He is awesome. So I'll have to do some research what he thinks about that. But, guys, I'm going to head out for the night. It's getting a little bit too cold. But I wanted to pop on and just say hello. Hopefully all of you are having a really good start to 2026. And we should be doing more live streams. So if you enjoyed them, subscribe to the channel, leave a like on the video. And we'll see you guys maybe tomorrow, maybe Sunday. So Mark, thank you so much. Trade Brigade, Happy New Year to you. Thanks for joining as always. We appreciate when you join us here. Laced Mushroom, Mohammed, Larry, TD, Sabrina Fair, Suarez, Ed Dunkel. Hopefully your New Year's off to a good start. Lisa, Tesla James, let's talk Tesla soon. Oh, I forgot to talk about Tesla. I have some really crazy Tesla updates for you guys. I'm about to blow your face off with these Tesla updates I have. Anyway, gotta go. Take care.